What is NPV and what is IRR? What are the difference between them? And when you have to use NPV and when IRR? To know, stick with us. Hi guys, you are watching Business Shipping Management. Consider subscribing if you want to keep up with all business related videos. Today we are going to talk about NPV and IRR. What are NPV and IRR? Net present value, NPV, is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. On the other hand, the internal rate of return, IRR, is a calculation used to estimate the profitability of potential investments. Both of these measurements are primarily used in capital budgeting, the process by which companies determine whether a new investment or expansion opportunity is worthwhile. Given an investment opportunity, a firm needs to decide whether undertaking the investment will generate net economic profits or losses for the company. How we determine NPV. To do this, the firm estimates the future cash flows of the project and discounts them into present value amounts using a discount rate that represents the project's cost of capital and its risk. Next, all of the investment's future positive cash flows are reduced into one present value number. Subtracting this number from the initial cash outlay required for the investment provides the net present value of the investment. Let's illustrate with an example. Suppose Alpha Media Company wants to buy a small publishing company. Alpha determines that the future cash flows generated by the publisher, when discounted at a 12% annual rate, yields a present value of $23.5 million. If the publishing company's owner is willing to sell for $20 million, then the NPV of the project would be $3.5 million, $23.50. The NPV of $3.5 million represents the intrinsic value that will be added to Alpha Media if it undertakes this acquisition. How we determine IRR. So, Alpha Media's project has a positive NPV, but from a business perspective, the firm should also know what rate of return will be generated by this investment. To do this, the firm would simply recalculate the NPV equation, this time setting the NPV factor to 0, and solve for the now unknown discount rate. The rate that is produced by the solution is the project's internal rate of return, IRR. For this example, the project's IRR could, depending on the timing and proportions of cash flow distributions, be equal to 17.15%. Thus, Alpha Media, given its projected cash flows, has a project with a 17.15% return. If there were a project that Alpha could undertake with a higher IRR, it would probably pursue the higher yielding project instead. Thus, you can see that the usefulness of the IRR measurement lies in its ability to represent any investment opportunity's possible return and compare it with other alternative investments. Another situation that causes problems for people who prefer the IRR method is when the discount rate of a project is not known. In order for the IRR to be considered a valid way to evaluate a project, it must be compared to a discount rate. If the IRR is above the discount rate, the project is feasible. If it is below, the project is considered not doable. If a discount rate is not known, or cannot be applied to a specific project for whatever reason, the IRR is of limited value. In cases like this, the NPV method is superior. If a project's NPV is above 0, then it's considered to be financially worthwhile. Key takeaways: NPV and IRR are two discounted cash flow methods used for evaluating investments or capital projects. NPV is the dollar amount difference between the present value of discounted cash inflows less outflows over a specific period of time. If a project's NPV is above 0, then it's considered to be financially worthwhile. IRR estimates the profitability of potential investments using a percentage value rather than a dollar amount. Each approach has its own distinct advantages and disadvantages. What are the difference between NPV and IRR? The two capital budgeting methods have the following differences. Outcome. The NPV method results in a dollar value that a project will produce, while IRR generates the percentage return that the project is expected to create. Purpose. The NPV method focuses on project surpluses, while IRR is focused on the break-even cash flow level of a project. Decision support. The NPV method presents an outcome that forms the foundation for an investment decision, since it presents a dollar return. The IRR method does not help in making this decision, since its percentage return does not tell the investor how much money will be made. Reinvestment rate. The presumed rate of return for the reinvestment of intermediate cash flows is the firm's cost of capital when NPV is used, while it is the internal rate of return under the IRR method. Discount rate issues. The NPV method requires the use of a discount rate, which can be difficult to derive, since management might want to adjust it based on perceived risk levels. The IRR method does not have this difficulty, since the rate of return is simply derived from the underlying cash flows. Each approach has its own distinct advantages and disadvantages. Generally, NPV is the more heavily used method. IRR tends to be calculated as part of the capital budgeting process and supplied as additional information. Thank you for watching. If you found the video helpful, please consider subscribing our channel and share the video with your friends. Hope to see you in our next video.